Welcome back to The Explainer. Today, we're unpacking a truly chaotic, high-stakes year of 2026 for Shell plc. It's a year that perfectly illustrates the incredible tension at the heart of the modern energy sector, contrasting massive financial victories against mounting external liabilities. We are going to look closely at how one of the world's largest energy companies navigated a landscape completely filled with geopolitical turmoil, legal roadblocks, and shifting strategic priorities.
It's the ultimate corporate paradox, right? How in the world does a company rake in near-record financial windfalls on one hand while simultaneously stepping into a massive strategic minefield of legal defeats and digital crises on the other? It's a fascinating balancing act, and exploring this paradox is going to tell us a lot about where the global energy industry is actually heading.
Well, to make sense of it all, here's our roadmap for today. We'll start with those record-breaking financial profits, look at their strategic retreat from renewables, unpack a massive legal defeat in South Africa, dive into a major cybersecurity breach, and finally, look at the mounting shareholder pressure shaping their future.
Section 1. Record-breaking financial profits. And trust me, calling this a year of financial windfalls is putting it lightly. Let's just look at the sheer scale of the numbers here, because they are absolutely staggering. In the first quarter of 2026, Shell pulled in adjusted earnings of $6.9 billion, and that was already their best quarter in 2 years. But then came Q2. Analysts were expecting a good quarter, maybe $8.9 billion. Instead, Shell completely blew past those expectations, hitting a massive $9.84 billion. That is literally the second highest quarterly profit in the company's entire history.
So what exactly fueled this massive surge? Well, it's a really interesting mix of external geopolitical luck and relentless internal efficiency. On the outside, you had higher oil and gas prices driven directly by the Iran conflict. But internally, Shell was running a ridiculously tight ship. They hit a 102% record refinery utilization rate, pulled off some exceptionally strong trading, and, get this, achieved $700 million in structural cost reductions in just the first half of the year alone. That brings their total cumulative savings since 2022 to an unbelievable $5.8 billion.
And if you're wondering where all that cash went, well, it went straight into the pockets of shareholders. Shell announced its 19th consecutive quarter, let that sink in, 19 quarters in a row, of funneling at least $3 billion into share buybacks. Plus, they bumped up their quarterly dividend by another 5%. In Q1 alone, total shareholder distributions reached $5.3 billion. Financially speaking, the engine wasn't just humming, it was roaring.
Which brings us to Section 2, the retreat from renewables and their very deliberate pivot back to core fossil fuels.
Because the really crucial question here is, how did CEO Wael Sawan decide to reinvest all those soaring profits? The answer is pretty stark. They essentially packed up a huge chunk of their green energy portfolio. In August of 2026, Shell announced the sale of their entire European onshore renewables business. We're talking 500 megawatts of active projects and a massive pipeline to their French rival, TotalEnergies. On top of that, reports surfaced that they were actively preparing to unload an offshore wind portfolio worth over $1 billion. They are actively shrinking their 4.5 gigawatt renewable capacity to refocus almost entirely on core oil, gas, and hydrocarbon extraction.
And to prove that point, instead of putting money into wind or solar, they dropped a cool $16.4 billion in April 2026.
And what did $16.4 billion buy them? The Canadian energy firm ARC Resources. CEO Wael Sawan flat out said this deal establishes Canada as a heartland for Shell. This single acquisition added 370,000 barrels of oil equivalent per day to their portfolio. It is a massive bet, firmly doubling down on fossil fuel extraction right in the heart of Canada's Montney Shale Basin. They are clearly banking on traditional energy for their future. All right, let's move to Section 3, the South African legal defeat, because this corporate strategy certainly does not exist in a vacuum. Let's look at the liabilities side of the ledger. August 14, 2026 was a serious day of reckoning for the company. While profits were booming globally, the Constitutional Court of South Africa dealt a final, completely decisive blow to Shell's plans to explore for oil offshore along the country's Indian Ocean coastline, an area known as the Wild Coast. The court permanently set aside an exploration right held by Shell and Impact Africa. You might be wondering, how did a corporate giant lose this legal battle? Well, the court found massive, severe flaws in how they handled local consultations. They published their public notices only in English and Afrikaans, completely ignoring the fact that the local residents in the affected area are predominantly isiXhosa speaking. They essentially excluded thousands of community members from having any real voice in the process, even after traditional leaders explicitly warned their consultants that broader engagement was needed.
And this really illustrates the human element of what was at stake here. Just listen to this powerful quote from Justice Jody Kolopan in the majority judgment. He stated, "The sea is of deep importance to coastal communities, central to livelihoods, ancestral practices, traditional healing, and spiritual life." The court formally recognized that for these communities, this wasn't just a basic environmental dispute, it was a fight for their ancestral way of life and survival. Environmental groups like Sustaining the Wild Coast and Greenpeace Africa absolutely celebrated this as a landmark victory.
Now, let's look at Section 4, the cybersecurity breach, because those legal problems were really only half of the crisis. Think about how these events converge into one incredibly stressful timeline for Shell's leadership. On August 3rd, they make headlines for selling off those renewable assets. Then, fast forward to August 14th. On the exact same day that Shell lost that massive legal battle in South Africa, they were thrust into a global cybersecurity nightmare.
The threat came from a notorious Russian-speaking ransomware syndicate known as CLOP. This is a group that specializes in enterprise data theft and extortion. They reportedly targeted specific vulnerabilities in manufacturing and design software, hitting nearly 50 global companies all at once, including major names like Philips, Fiserv, GE, and of course, Shell.
In the fallout, hackers allegedly stole roughly 89 gigabytes of internal corporate data. I mean, it's incredibly ironic, isn't it? A company that literally powers the globe having its own internal networks compromised. Shell confirmed they were investigating a possible cyber incident with external experts. And while they haven't confirmed exactly what data was taken, it just underscores how severe digital vulnerabilities are today, even for the wealthiest, most well-resourced corporations on the planet. Which brings us to our final section: shareholder pressure and future, and the growing activist divide inside the company itself. So how does all this tension, record profits versus major legal and digital breaches, actually play out in the boardroom? Well, at the May 2026 annual general meeting, leadership looked pretty secure. CEO Wael Sawan received 98.9% support, and Chairman Andrew Mackenzie got 94.4%. Obviously, shareholders are pretty happy with those near $10 billion quarters and massive stock buybacks. But there was a very clear underlying current of climate-focused activism that made its presence known, specifically through a resolution filed by a group called Follow This.
Now that Follow This resolution, which pushed Shell to disclose how its strategy actually aligns with declining fossil fuel demand, did fail. But consider this, it still grabbed a 12.7% slice of support from investors. And while 12.7% might sound small, that minority vote was backed by 21 major institutional investors who manage $1.2 trillion in assets. Campaigners see that double-digit dissent as a huge, glaring signal of growing anxiety over Shell's long-term climate strategy.
So as we wrap up this explainer, we're left with a pretty fascinating picture of Shell in 2026. The company is betting big on oil and gas, and right now, that bet is paying off handsomely in cold, hard cash on the balance sheet. But you really have to ask yourself, is maximizing short-term hydrocarbon profits actually sustainable when you are facing such profound external resistance? Can they really outrun the mounting legal defeats, these massive digital vulnerabilities, and the inevitable climate pressures of the future? The profits are historic, for sure, but as the events of 2026 proved, the risks are historic too. Thanks so much for joining me today, and keep questioning the numbers behind the headlines.